Hey guys, welcome back to another quick video. Today I will be talking about the difference between strategic and financial buyers. Now, a key question that bankers have to ask themselves when representing a firm targeted for acquisition or for research purposes is, was the acquirer a strategic or a financial buyer? Now, what does this question imply and how does it impact valuation considerations? Now, a strategic buyer is a company that provides products or services and is often a competitor, supplier, or customer of the target firm. They can also be unrelated to the target's industry, but recognize the strategic potential for synergies reflected in the P&L line. Now, a financial buyer includes private equity firms, venture capital firms, hedge funds, family investment offices, and ultra high net worth individuals. These firms and executives are in the business of making investments in companies and realizing a return on their investments. Now, the best way I can explain the difference between a strategic buyer and a financial buyer is by using an example. So say, for example, we're talking about a micro oil and gas services company based in Alberta, Canada. Now, a strategic buyer would be Suncor, it would be another Canadian or American oil and gas company that either works in the same industry, uses their services, or is related to them in some way from an industry perspective. Now, a financial buyer would be a Canadian billionaire who wants to make an investment in the company to realize a return on their investment, or it can be, a hedge fund based in New York who decides that this business is undervalued and they want to acquire the business. So that's really the difference between the two. Now, because these buyers have fundamentally different goals, the way they will approach your business in an M&A sale process can differ in significant ways. One buys to make money, while the other invests money to make more money. Now, the key differences between strategic and financial buyers are: 1, how they evaluate the target's business; 2, how they determine the investment merit of the industry; 3, the strength of back office infrastructure; 4, the impact of the investment horizon; and 5, the transaction efficiency. And when you kind of think about the differences, I'm sure some people will initially think, okay, well, they have different kind of investment goals. And that's a very simple way of describing the difference between a strategic and financial buyer. But when you really go in depth, these 5 key differences kind of really reveal a lot about how you approach the valuation and the analysis of a respective transaction. And just to kind of talk about the importance of this, for investment bankers who are either doing a precedent or transaction analysis, when they look at previous transactions in that respective industry, one of the key questions is, was the buyer a strategic or financial buyer? And off that, they will then decide, did they pay more of a premium because of because of that position, or less of a premium? And sometimes they'll even segregate the two, and they will analyze the strategic buyers and those transactions, and then the financial buyers in those transactions, and they'll determine 2 different mediums and averages for the respective multiples that they'll be looking at. So that's why it's really important to understand the difference between the two. Now let's look at number 1, evaluating the target. Now, strategic buyers evaluate acquisitions largely in the context of how the business will fit alongside its existing operations. By asking strategic questions like, are there manufacturing economies of scale, the strategic buyer cares about synergies. Conversely, financial buyers usually can't integrate the target into a large company, so they evaluate the asset as a standalone entity. So really the difference from a valuation perspective is that strategic buyers will account for the synergies that exist within that transaction and therefore pay more than usually the financial buyers. Now, there's also the determining the investment merits of the industry. Strategic buyers who are in the same or related industry as a target won't need to conduct as much industry research because of their existing familiarity at the ground level. For the strategic buyer, selling them on a business is much more of a micro discussion. Conversely, even if financial buyers have had previous transaction experience in the industry, their level of knowledge is much less, so much more time is spent on macro factors. So the overall timeline of that transaction differs between strategic and financial buyers. Now, with regards to the strength of back office infrastructure, when a financial buyer analyzes a business, a lot of the time is spent on determining whether the existing infrastructure and back office support system is efficient and profitable. Many of the cost-saving initiatives and changes made early on post-acquisition is focused on improving the support and technology systems of the company to better increase the speed and level of communication. especially for older companies and industrials, IT, information technology investment, is a huge consideration when focusing on value creation. So essentially what I'm trying to get here is that with financial buyers, they're looking at the low-hanging fruit within that organization, things that they can really improve on to either reduce costs or improve the efficiency of operations. A majority of the time, it is due to weakness in the back office infrastructure. With strategic buyers, however, the time and focus spent on back office analysis of the business is significantly less, as there will be existing crossover once integration begins. With a company in the same or related industry, there will be several departments which need to either be eliminated or merged with the existing business. This means that less effort is put into learning about the back office, which speeds up the due diligence. So if I am an oil company acquiring an oil and gas services company, then my back office, which I'm of course familiar with and feel that is very strong, can then take on that weak back office. We can fire those people and then just shift that business onto our back office, and we already integrate and account for those low-hanging fruit. So it's much easier for strategic buyers to recognize the cost efficiencies that might come from the back office infrastructure. Now, the investment horizon. Probably the biggest difference is the investment horizon of each acquirer. For strategic buyers, adding the target to its portfolio of businesses allows the company to diversify and ensure longer-term stability and growth in market share. For financial buyers, the flip is the focus. As a business is acquired, costs are cut, efficiencies are implemented, and then the unit is put up for sale within 4 to 5 years. And the typical PE, investment is that you realize an internal rate of return of excess of 25%. You change or sell different non-performing assets, and you could cut down on costs, and then at the end of the 5 to 6 years, you then sell that business and you realize that internal rate of return. With strategic buyers, that's not the case. You're adding that business to improve your overall business line and your overall efficiency within that industry, whether it is to support market share or whether it is for research and development. So there are different reasons from an investment horizon perspective. Now, the transaction efficiency. Financial buyers are in the business of making acquisitions. So from a speed perspective, they are much more capable of making decisions on what businesses to buy and how to structure those deals. Strategic buyers can be much slower, as their main priority is to run the existing business and make additional acquisitions if possible. While yes, the financial buyers might be faster and more well-equipped internally to complete these transactions, strategic buyers can always hire advisors. So, the counter argument to the transaction efficiency, difference, which states that financial buyers are more well equipped to really complete these transactions than strategic buyers, is that, the strategic buyer can just simply hire an investment bank and really depend on that investment bank to really find the best and quickest deal. Now, traditionally, strategic buyers have been able to pay higher purchase prices than financial sponsors due to their potential ability to realize synergies from the transaction, among other factors, including lower cost of capital and return thresholds. In addition, because of these tangible assets, and are usually larger, the strategic buyer has better access to capital. So essentially what this slide is trying to get at is that although, yes, the transactions might be completed quicker with the financial buyer, when looking at the full transaction, the strategic buyer is better able to pay a higher price and at the same time get access to cheaper capital. Because think about it. Think about the difference between having a private equity company and General Electric approaching this company. General Electric will probably be able to source cheaper credit from banks because of their size of their business, and at the same time they'll be able to pay a higher purchase price if they really want to buy that business, versus the private equity firm, which is really limited by their models and the respective targets that they need to achieve, which is that internal rate of return. So that's a big difference. So which is better? Now, if the seller wants the highest price possible, an auction process is best, and depending on market conditions, either a strategic or financial buyer will offer the highest bid. If the seller wants a high price but has other concerns, if the target wants to ensure the protection of key company values, employees, a strategic buyer is better, because at the end of the day, that strategic buyer is going to take care of those assets because they're going to integrate those assets within their own business, and they care about the employees that are running those assets. They care about the values that exist within that business. And so if that buyer not only wants a high price but also cares about other intangible values that come with its business, then a strategic buyer is better. Now, if the seller wants to cash out but would like to remain for a few years within the business, then a financial sponsor is better. And that works well for the financial sponsor. Usually when a private equity firm acquires a business, sometimes they don't kick out the management team. And sometimes they speak with the management team and try to reason with them and say, you know what, how about you continue to perform with us? And all we're interested in is making this buck. And at the end of the day, if we can improve your business from an operation perspective, then that helps you as well as us. Right? And so from that perspective, if the seller just wants to cash out and at the same time remain within that business, then the financial sponsor is better. Okay, so that's pretty much it. As always, if you did enjoy this video, please subscribe to the channel and like the video. If you have any questions, I do recommend that you comment below and I'll be sure to reply to any questions you have. As well, check out some of my other videos covering topics like IPOs, investment banking, techniques that you'll be asked in investment banking interviews or will need to use on the job. Also DCF valuation techniques and all that. So that's all on the channel. So if you're interested in that, check the channel out. You can just click on my channel and look at the videos and you'll see it there. As well, if you're interested in financial research, the markets, investing, all that, check out my Seeking Alpha page where I publish a lot of investment research. And I'll link in the video description to my profile. Other than that, hopefully you guys enjoyed the video and stay tuned for more. Thank you.